So I couldn't be in class today, so we had to film this. I'm actually on road for baseball right now, so this is gonna have to do instead. To start off with, part of my section included the International Financial Statement Analysis for Nike. When you look at Nike's financial statement analysis for their international business, you can see that more than half of their revenue comes from markets outside of the US. That is 15.3 billion out of the 30 billion that they do every year. And this was a statement made by Nike in their last 10K report. In recent years, uncertain global and regional economic conditions have affected international trade and have caused a rise in protectionist actions around the world. These trends are affecting many global manufacturing and service sectors, and the footwear and apparel industries as a whole. We are not immune. So what I kind of get from what they're saying here is because they're the biggest company in this sector, even they're being affected by the tough economic conditions overseas. And I think this is especially important for Nike because a lot of their business comes from international trade. Moving over to Under Armour, it's a much smaller company based out of the US, so a lot of their sales is done domestically. They did 345 million outside of the US, and they did 3.4 billion domestically. So it's a much different type of company with their target market and where they're going domestically. And then an interesting fact to note about Under Armour's international trade is that 80% of their sales overseas come between the Asia Pacific markets. So that's like the China, Japan, and those countries over there. Moving on. So I'm in charge of doing the activity ratios. So I decided to pull up this Investopedia video real quick to show you a little bit of definitions.
How quickly a business can turn assets into cash or sales is a good indicator of how well that business is run. Activity ratios measure how effectively a business uses its assets. Management and accounting departments can use several activity ratios to gauge their business's efficiency. Two of the more popular include inventory turnover and total assets turnover. The inventory turnover ratio reveals the number of times a company created its inventory and sold it over a set period. It's the cost of goods sold divided by average inventory cost. If it cost a company $100,000 in a year to make the goods it sells, and its inventory is $20,000, then its inventory turnover ratio is 5, meaning it made and sold its inventory 5 times in a year. Total assets turnover shows how fast a company turns assets into revenue. It's sales divided by average total assets. If a company sold $150,000 of goods and its assets were $50,000, it turned over its assets 3 times in a year. Most companies need to compare their activity ratios with their competitors to truly gauge their efficiency. But higher ratios means a business is making better use of its assets. Activity ratios do not work well when comparing businesses across different industries.
So that was a little bit of what the activity ratios are about. For the most part, especially in this sector, the higher the number, the more effective the business is using their time and the way they're selling the goods. The inventory turnover is a ratio showing how many times a company has sold and replaced inventory in a given period. And what I used was the yearly inventory turnover, and the equation for that is inventory turnover equals the cost of goods sold divided by the average inventory. So we're going to take a little look at what these companies, the numbers for that. Nike's at 3.89, which is by far the leader in the sector, and Under Armour's 2.78. Under Armour's at 2.78 is the lowest. They're in a similar category of Skechers, but what this tells us is that Nike's very effective at developing new inventory and getting it out. They're a huge company, so you could kind of expect these numbers to be this way, that Nike's higher than Under Armour just because of the amount of product and stores, locations, and international locations they have. So this was to be expected. The next ratio that we're doing for activity ratios is the working capital turnover. The working capital turnover is a ratio that measures how effectively a company is using their working capital to support given levels of sales. So the equation for this is working capital turnover equals sales divided by average working capital. And again, Nike had a 4.0 and Under Armour at a 1.97. And this is the same. In this industry, Nike's the highest and Under Armour's around the lowest. What this is telling us is that the working capital that Nike has is using it way more effectively, almost double more effectively than Under Armour. And you can kind of see this in recent years. Under Armour's been struggling when Nike's been excelling, at least on the stock wise. And I think investors see these numbers and can really see that Nike's using their resources effectively while Under Armour has been struggling, and you can see that in what their stock's been doing. Okay, the final activity ratio is receivables turnover. The accounts receivable turnover ratio is an accounting measure used to quantify a company's effectiveness in collecting its receivables or money owed by clients. This ratio shows how well a company is using and manages the credit it extends to a customer and how quickly that short-term debt can be collected. And the equation for this is receivables turnover equals sales divided by average trade receivables. So we can see here is Nike again much higher than Under Armour, 10.41, when Under Armour is at a 6.10. What this ratio is telling us is how quickly these companies are getting paid from the credit they have given out. So this is just pretty much how liquid their assets are. So Nike is getting at a much quicker rate than Under Armour. They're getting much more assets quickly to reinvest in their company, to pay out dividends, and to overall help their stakeholders. So now we're looking overall who's better, Nike versus Under Armour. You can see through all the ratios that Nike's much better and more efficient at the activity ratios at least. When looking at the industry, Nike has the highest ratios and Under Armour has the lowest for pretty much all of it. So you can definitely tell that Nike's a much more efficient company, and that shows in their earnings overall. I feel that being a more domestic company that Under Armour has hard times moving as much inventory as they do than Nike does. Because Nike has all these overseas locations, when Under Armour doesn't have that much, it's tough to get all your product out and get the inventory turning over or selling all the inventory that you have created. So that's my part. I hope my group takes care of the rest.